So this is what a multi-step income statement looks like. We talked about grouping and providing subtotals. You can see that at the end we still want to reach net income. This is the same goal. So for all the income statement, remember we want to get to whether there's income or net loss. So at the end we still want to get to net income. It's just that in the middle we break it down into different sections. Okay, generally speaking, you can basically divide multi-step into 3 main sections. The first one, we want to get to gross profit. And gross profit, last week I briefly mentioned it. Basically, it's the excessive amount that the company is receiving from customer over what they paid to vendor. So if you look at the numbers there, you see sales revenue in the first line. That's the money that you'll be getting from the customer, right? Cost of goods sold is inventory's cost that relates to the product that you sold out to customer, and gross profit relates to the difference between the two. So it's the excessive amount that you're getting from customer that's over the money that you paid to vendor.
Is this like the debit side and the credit side, or is just a...
Oh no, this is the statement. So it's basically the right side is, the left side is a subtotal of it for calculations. So you see the 2 contrary accounts we list there together, and then you add them up, it equals the right side 3,400. Okay, so left side is just the detail items, right side is a summary subtotal of those items. Okay? Alright, so this is an income statement, so it's not the debit credit side. Debit credit will exist for worksheets, right? For statements, usually the left and right, left side is detail items, right side you have a summary of those items grouped all together. Okay, so if we look at the first subsection here, before we get to net income, we calculate gross profit, $75,100. And again, it's only considering the cost of goods sold expense. Okay, not all the other expenses. We're only considering inventory cost expense after we sell it to customer. So first section, we start from sales revenue, and then if there's any contract accounts, of course, we want to reduce them to represent net sales. And then use net sales minus cost of goods sold. That will give you gross profit. So again, net sales is the retail price. Cost of goods sold is the original cost you used to pay to vendor. Gross profit is the difference between retail price and cost of inventory. So that's the first subtotal. But basically, this gross profit has to be high to a level that enables company to cover all the other expenses. Then company will be able to get to net income. If that part is already weak, then let alone all the expenses, and it's very likely that the company will get a net loss later on. Okay, so having a high amount of gross profit really is a good indicator up front to determine whether later on there's actually net income for the company. Okay, because gross profit is only considering cost of goods sold expense. And you can see in the bottom there's a bunch of other operating expenses to cover necessary incurred to help the business run their daily activities. So for example, rental, wages, advertising, any costs related to marketing your product, utility. All of these are necessary costs incurred to support the store, support administrative offices, but that's other than cost of goods sold expense. Okay, so you can see all the other ones really does not exceed the $90,800 there for cost of goods sold. Relatively, they are more minor, these expenses. But still, it has to be covered by gross profit. So you have that $75,100, then you subtract all the other expenses incurred, the major expenses here, which groups to a total of $20,700. Then this will give you operating income. Okay, in the next few slides, I'll define what is operating expenses and what are the differences between selling and general. Right? This slide, you just need to know the general structure of the income statement. So operating income considers all the major expenses after gross profit. After you subtract all the major expenses, then you get the second subtotal, the blue arrow there, operating income, $54,400. Then there's another section, other revenues and expenses. These are even more minor expenses. So if you borrow money, you may have interest expense, or if you borrow money to others, you may have interest revenue, or if you trade assets, later in Chapter 9 we'll talk about gains and losses of trading assets. All the other minor expenses and revenues that doesn't really relate to daily operations on selling the product will fall into this category. Okay, so some businesses may not even have this category, then they will have the same amount of operating income, which equals net income. Okay, but in case there's also other minor expenses and revenues not related to daily transactions, daily selling or purchasing transactions, then we put it under the last category. After subtracting or adding it, then we get to net income. Okay, so there's three main sections. First one solely relates to inventory purchases and inventory selling, not considering other expenses. Second one captures all the major expenses that relates to selling the items, selling the products, marketing the products, anything that relates to stores and administrative offices. Third section, minor expenses and revenues. Okay, so there's three subtotals that you would see in the multi-step income statement. It gives more detailed information to outside users.